Okay, great. Good morning, everyone. Thank you very much, Rob. It's a real honor to be able to kick off the panels in this conference with a panel on regulation. I think it shows just how much regulation is valued and important in this space, even though it can seem that the regulations are lacking or they're taking a while to emerge. They are nonetheless going to be key to whether the potential that we've heard a lot about for this sector can really materialize. And it's a particular privilege for me because we have a global perspective represented on this panel, basically. So we have Chris from Guernsey, we have Val from the US, and we have Simon from here in the city. And I think this is a particular sector that is genuinely cross-border. It's going to be impossible to look at things in jurisdictional silos. Different jurisdictions will run off, do things, to try and get the first bit of regulation or the most comprehensive bit of regulation or the most extraterritorial. But realistically, I don't think any of this can succeed without some degree of looking at it from a global perspective and hopefully achieving some coordination. So without saying any further on that, I'm going to get into the questions. I'm going to ask the panelists, when I first call on you, if you are happy to share a little bit about yourself and the perspective that you're kind of bringing, how you're looking at this question. And so with that, the first question is on definitions. All of us are sort of regulatory, lawyers or specialists, and we're obsessed with definitions, basically. What is something? Is it a this or a that, right? That's basically our job. The difficulty, I think, with crypto is that there's a temptation to look at it as if it were just all one thing, because the underlying technology is like common, right? Basically, so when you're in that space, you're in the crypto space or you're in the DeFi space, and you kind of think that everything that you produce in that world is the same thing. But I'd like to ask the panel, why is it that definitions are particularly important in this sector, and why is it increasingly kind of wrong to think of this thing as if it were just a single thing? So maybe I'll start with Val for that question, and how you're seeing that from a US perspective and your own practice.
All right, perfect. Hi, everyone. I'm Val Dahiya. It's a pleasure to be with you today. I'm a partner at Morrison & Foerster. I head up the Securities and Derivatives Regulatory and Compliance practice. I was a former regulator for over a decade. I was at the SEC, and then I went to the primary regulator for broker-dealers, and then went into private practice. So when I think about it from a U.S. perspective, definitions have played a substantial role in the way that the U.S. has responded to the tokenization of various assets, including the issuance of stablecoins. And initially, the SEC was the dominant regulator in the space, and they took the position that many of the tokens or coins that were issued were illegal unregistered securities offerings based on the Howey test, which is a 1946 case from the US Supreme Court that basically said, where you have an asset that is not traditionally considered a security, if based on the economic realities of the transaction or the way that it's offered and issued, it can be deemed a security and subject to compliance with federal securities laws. And so where you have an exchange of value, a common enterprise, or a reasonable expectation of profits based off the efforts of others, then you have a security. And so in 2025, with the election, the second election of Donald Trump, he made it clear that crypto was a high priority for his administration. And we saw the SEC starting to really relax its approach on how it was regulating any type of coins or tokens issued in the US or sold to US persons. And what we saw was the SEC in June of 2025, the staff issued a no action letter that basically stated that if a stable coin is issued and it's backed one-to-one by a US dollar, if it's redeemable for a US dollar, and it doesn't offer yield, ownership rights, or any other indicia of a security, then it would not be treated as a security by the SEC and would be subject to the banking regulators, whether that is state or federal. And then we saw Congress pass the Genius Act in June of 2025, which further clarified that certain stable coins were banking products and not securities. And it really did establish a comprehensive regulatory framework for the treatment of stable coins and provided issuers with far more clarity and consistency around how they can be offered under what circumstances and what are the rules of the road from a compliance perspective.
No, great. I mean, I remember loving this topic because it made everyone a US securities lawyer. Everyone suddenly knew what Howie was. Maybe Simon, your perspective from being here in London, where we don't have a Howie test, but maybe we look at things in a similar way.
Yeah. So hi everyone, Simon Burden from NatWest. I'm actually a competition lawyer. By extensive background, having worked in private practice in the UK competition regulator, and then I was at HSBC for a while, then I was at Vodafone, and now at NatWest. I think in the last couple of years I've really been getting into regulatory policy issues around digital markets, digital assets, and most recently artificial intelligence. It's quite an exciting time to be working in a bank in these areas with a lot of change going on. So I guess when we talk about crypto assets, what do we mean? I suppose there's an element of path dependency here in that we started with the term crypto back with the sort of, I think even before the Bitcoin white paper, but it was viewed as peer-to-peer electronic cash system based on cryptographic proof instead of trust. So it was all about removing intermediaries and setting up these decentralized blockchains originally. So crypto was both about how you secured the asset, how you transferred the asset, and then also there were sort of protocols set up for how the value of the asset would change over time as well. So it was all really, really embedded. And then it's just been a case of sort of a layering effect since then as new types of assets have been tokenized. And the UK, I think, came up with a definition in sort of 2018, the Crypto Asset Task Force, saying that it's a cryptographically secured digital representation of value or contractual rights using DLT that can be transferred, stored or traded electronically. So that seemed quite a sensible definition 10 years ago, and so it could cover native crypto like Bitcoin. It could also cover tokenized real-world assets, which are sort of now defined as specified investment crypto assets, but they are qualifying crypto assets. And then we have qualifying stablecoins as another subset of qualifying crypto assets. And then where I think it gets quite interesting is if you look at recent efforts by banks in the UK to tokenize their deposits, you could also say that falls into the definition of a crypto asset. Although I think the Bank of England has been fairly clear that they look at this very much as deposit taker innovations in deposits, so not necessarily crypto assets. So I think these definitions do matter because they are what drive who's going to regulate, what sets of rules are going to apply. I think it's very helpful for real-world tokenized assets that we have specified investment crypto assets where we're saying well, it's still going to be subject to investment laws and then also sort of rules around tokenization as well. So that is useful, and I'll stop there.
No, great, and thank you for kind of reminding us of this kind of history and where we started in thinking of these things conceptually. Now to having definitions, for example, in the UK that try to bring in a degree of like policy. What do we want to regulate and how, and where do we want to draw the distinction? So that's been quite useful. And then Chris, I think you've perhaps been steeped in this idea of regulation and policy making and identifying what do we want to regulate in Guernsey and how the market there is looking at things. What's your perspective on that?
Sure. So, morning everyone. My name's Chris Hutley-Hurst. I'm a partner at Walkers in Guernsey and I head up our Channel Island regulatory practice covering both Guernsey and Jersey. So what's interesting about where Guernsey is at the moment is that it's in the middle of redesigning its regulatory laws and practice in order to regulate appropriately stablecoins and tokenization. But there's been a huge engagement between the regulator and industry. So these are exactly the things that we've been grappling with in various discussions is firstly, what do we regulate? How do we define that? And then once we've defined it, how do we actually regulate it? Because I personally see crypto assets as really meaning assets that exist on the blockchain. And you've kind of then got to drill down and go, well, what is that and why are you using that? And very broadly, I think where we're going to be going is we're going to be saying, okay, if it's a tokenized security, well, then it's a security. So we'll regulate it in the same way that we regulate other securities. If it's a stable coin, assuming it's a payment stable coin, then it's a means of payment, so we'll regulate it as a means of payment. But those are things that we're still looking at, and it's hoped that our regimes will go live in about 2 or 3 months' time.
Got it, thank you. And this is a question where, I'll add a perspective, basically. This is the only kind of question where I'll kind of be a panelist, basically, because I do think, feel strongly that, definitions matter, and especially kind of hearing, how we kind of each see it. I think finance is full of products which are economically the same, basically. But through law and through regulation, we treat them very differently, and they have very different consequences, basically. So, those of you who are involved in securities financing, right? The repurchase agreement, right? Economically very similar to a secured loan. But by virtue of how exactly the market sees it, and also the legal techniques that you use, that has very different consequences depending on whether you say it's a secured loan or it's a repurchase agreement, right? And all of finance kind of really depends for certainty and for obligations to kind of have real economic value, that judges can see these things and it kind of support the distinctions that the market is drawing. I think the problem with crypto, or the reasons why the crypto assets make this kind of question very challenging is that you have a single technology that can mean that what the market might see as different products actually operate in very much the same way, basically. So a tokenized deposit operates in the same way as a stablecoin, basically, right? And so we have the challenge where the market participants might argue that the thing that they're producing basically is this. Right? And when regulatory lawyers say, but actually it could also be that, and we don't actually have regulation that says clearly it's this or not that. Imagine if that goes to court, right? And judges are going to look at those traditional regulatory categories and say it's a this, and we don't care how in your sort of world and in your product design you saw it as a that, and that really kind of matters, basically, because I think there's a risk here while the regulatory framework is uncertain, that in using the technology to create new instruments, basically creating things that were never instruments before, right? Taking a simple contractual obligation and tokenizing it, you create something that has regulatory consequence, but the picture is not really clear yet. So I think everybody kind of, when you're in this space, you kind of have to think of what are you creating and what is the art of the possible, basically, and not be too wedded to a particular characterization that kind of serves your purpose at the moment, but thinking, broadly about what different things can mean. It's just something I kind of felt, coming from kind of, the sorts of questions we're seeing in our practice, that it was worth sharing as well.
Right. I would just add to that oftentimes clients will say, well, they're focused on the technology, and I'm a technologist. We're a tech company, but the economic reality of what's being created is a financial instrument, and at least in the U.S., those are heavily regulated, and so sometimes there's a disconnect between understanding that while the technology is new and novel and evolving, the economic reality of what oftentimes people are using the technology to achieve, it's already been done, just in a different format, and it's regulated.
Yeah, no, I think that's very important. So we can, maybe start to look at some distinctions, I think, because we're saying, these, definitions matter. And I think, Simon, you already started to allude to, one particular product, tokenized deposit, basically, and how the regulators here might be seeing that. I find it very hard to distinguish between a tokenized deposit and a stablecoin, for instance. I mean, simplistically, I think of one as a bank product and one as a non-bank product, but maybe that's not quite right. So maybe, Simon, starting with you, from a bank perspective, do stablecoins solve a problem that, tokenizing deposits can't? Or is it actually vice versa? Actually, tokenized deposits is the thing you want, and stablecoin should be the sideshow. I don't know how you're seeing that.
Yeah, no, I like the way you frame that question, because I think it goes in both directions. I think probably the Bank of England is right to be talking about there being a multi-money verse or multi-money ecosystem emerging here. So, if I look at stablecoins, and bearing in mind I'm sort of work for a regulated bank, but they are good. They're crypto native. That's where they originated from. Was really probably just to be a parking spot or an intermediate leg in crypto markets. And then they probably just discovered an untapped market for dollars as a store of value in emerging markets with unstable currencies and unreliable governments. And then, yes, they sit on public chains. They can move 24/7. They're programmable. So they have a lot of those advantages. Tokenized deposits, on the other hand, there are two categories of tokenized deposits. You have what I would call the Great British Tokenised Deposit, GBTD. One of my favourite terms. I'd love to meet the person who baked up that idea. But account-based tokenised deposits, as we see with the GBTD, this is where the value remains on each individual bank's balance sheet. So the token is just sort of the programmable bit of the value where you can potentially lock and unlock the deposits, but you can still achieve atomic settlement, and it can still be done 24/7, particularly with collaboration with the Bank of England, who are able to, through synchronization, able to facilitate that. But you are still settling effectively in central bank money with an account-based tokenized deposit. Whereas if you have what I would call a deposit token, or what I think the PRA calls sort of transferable instrument deposits, that's where the deposit's value is actually sitting on chain. So if Bank of America send a Bank of America deposit token to a customer with a Citibank wallet, it's in the Citibank wallet, but it's still a Bank of America deposit token. And I think that has advantages because it means it's easier for you to move it around a public blockchain, but you always will need to be sending it to a KYC'd wallet. So if it's going to remain a deposit, the deposit issuer needs to know who's holding it. So it does still have some constraints. But I think where you get difficulties there is how is that going to scale across multiple different providers, because then you're going to have perhaps not all deposit tokens are going to be viewed equally, and you might get a slight divergence away from par. Whereas I think with the account-based tokenized deposits, that's less of an issue because you're always settling in central bank money. So there are some sort of interesting nuances around tokenized deposits, but in any event, they do offer the same programmability, the same atomic settlement as stablecoins. So they do enable delivery versus payments, and the GBTD is trialing this with retail and also on wholesale markets as well. And it benefits from all the consumer protection that deposits benefit from. You're maintaining singleness of money, and obviously you're also maintaining deposits as a source of funding for credit creation, which is very important in the UK, certainly at the moment. I understand alternative models are available. Whereas I think stablecoins will face some challenges if they gain a degree of sort of the systemic nature that the Bank of England is anticipating with its approach. Because they currently mostly operate on public chains, but I think the Bank of England still has some concerns around operational resilience, settlement finality, and who is accountable when things go wrong. So I think stablecoins face some headwinds in the UK to becoming as ubiquitous as deposits, and at the same time deposits are working quite hard to establish themselves as offering the same functionality as stablecoins. So I think it's going to be quite interesting in in a UK domestic sense to see whether we do see any systemic GBP stablecoins. I'm not sure whether that's going to happen or not. So I think, the very obvious use cases are already established, which is really as a sort of a trade cross-border type of currency that also has a lot of attractions in other markets. Whereas I think for UK domestic, we will see how things play out.
Yeah, no, I mean, and that's really interesting about exactly just, the role that the UK is seeing for deposit, the continued role that the UK is seeing for deposits, bank deposits. The US, I feel, Val, is a little bit different, right? It feels like, we've thrown our bets behind the stable coins, basically, the private stable coins. Is that fair? And, and is that deliberate, or is just how the market has kind of emerged?
I'm not sure if that's necessarily the case. I think there's a lot of froth in the market and people are kind of following this shiny new toy. But I think that regulators are very much concerned, and consumer advocate groups are very concerned about people understanding the difference between a stable coin and a bank deposit. Because if there are any insolvency issues, or there's a run as a result of redemptions with stablecoins in the U.S. where bank deposits are FDIC insured. If it's cash held in a securities account, then it's SIPC insured. So you have a certain level of protection built into the fundamental infrastructure. Whereas stablecoins do not have those same protections. It would be more similar to a money market fund that broke the buck. And so I think that's what Congress is really dealing with, and they're dealing with a lot of pushback. You have the new entrants into the market that are very aggressively behind the technology and the use of stable coins, and seeing the evolution and mass adoption of stable coins. And then you have the incumbent banks that are extremely deep-pocketed and really understand the rules and regulations. They've been around forever. They understand why the rules and regulations are in place because they've seen enough crisis in the U.S. market to know the importance of checks and balances. And so I think we're seeing that play out real time. I think we're all kind of anxious to see the passage of the Clarity Act. However, with the broken Congress, I mean, who knows if that will happen? So I think that we're just kind of watching as it evolves, but paying close attention to the potential unintended consequences.
Yeah, no, great, and really good to understand that it's a more varied picture, perhaps, than over here we tend to kind of understand, because we think of Genius, for example, and this is about stablecoins. So to understand that there are the same policy considerations as to what is the right instrument to represent the cash leg of transactions. But maybe turning to Chris actually, and moving on from that discussion about stablecoins versus tokenized deposits versus some other way of like money, basically. I sort of wonder if all of that is a distraction from the real kind of issue that is worth talking about, which is just about how do we tokenize financial markets? Just how do we move from the kind of more intermediated analog systems to financial market infrastructure. So you mentioned Clarity, Val. That we think of these things as sort of pervasive for the entire financial market ecosystem.
Yes, I mean, I personally think stablecoins are really important, but they are a component part of the more broader concept of tokenization. Mm-hmm. And I suppose, and I'm conscious that there's a panel session after this on tokenization, but I suppose if you look at the predictions, there's huge variance in the predictions, but even the lower predictions are big numbers. I was sort of looking just before this, and in the early 2030s, some analysts are predicting that there'll be up to $16 trillion of tokenized assets. I think Citigroup has predicted between 1.9 and $2 trillion of stablecoins. And I suppose if you take the top end of both, that kind of suggests that tokenization is the much bigger picture. Mm-hmm. But I don't think that means that stablecoins are not important. I mean, they are the payment rails that I think will be used as jurisdictions and markets. You talked about the tokenization of financial markets. I know that the New York Stock Exchange has announced tokenized trading, and I'm sure other exchanges...
NASDAQ has too.
Yeah, and other exchanges will be doing it. And in order to achieve that 24/7 T plus zero immediate settlement, you need a blockchain native means of payment. So I think stablecoins are very much there and a crucial part of the ecosystem.
Yeah. So you need both, basically. We need to think of this in the round, basically. So we'll move away, I think, from financial regulation, basically, to competition regulation, because we have a competition kind of law specialist on the panel. And so, Simon, sorry, this one's for you, I think. So yes, we focus on financial regulation, on prudential regulation, and all sorts of things that actors in this space have to kind of follow. But from a competition and consumer perspective, is there anything you think policymakers may be missing, or are they, are we actually thinking about competition in this space?
Yeah, I think I'll probably address this in two parts. The first is sort of how do you establish a level playing field between the sort of the new entrants into the market, the crypto natives, the stablecoin natives, and the established existing sort of TradFi players. And I think from sort of an incumbent bank perspective, the real challenge is in trying to encourage regulators to see the need for a level playing field, which means that the rules that were written kind of off the back of the global financial crisis, there needs to be a more pragmatic approach in terms of how those are applied and what we do with them. So if you're a bank, you're really going to be looking at are you going to be able to service customers who want to use stable coins effectively? So for your retail customers, if your retail customer says along and says, this merchant wants me to pay them in a stable coin, can you do that for me? They might just have a traditional fiat account with us. They might not have a stablecoin wallet. So how do we execute that transaction for them? We may need to hold an omnibus wallet with stablecoins in it, which means we're holding stablecoins on our balance sheet. So suddenly we really care about the capital treatment of stablecoins. We want to make sure that they're not sort of treated in a punitive manner in the same way other crypto assets are. And that then depends on whether they are, how the PRA views public blockchains. So there's sort of a lot of knock-on effects around that. And then for UK banks, we're still subject to a ring fencing regime. And are we going to be allowed to hold stablecoins on our balance sheets inside our ring fences? That's also very important. And then the probably the last thing, which is kind of the most interesting one for me, I think, and Val, you alluded to this as well, is the consumer protection angle, because with deposits, we have very solid consumer protection. With stablecoins, you don't necessarily, although one could argue that stablecoins inherently are perhaps a safer asset to hold than a bank deposit, but the bank deposits do have full insurance. So how are we going to provide a kind of a seamless interface for customers between stablecoins and fiat deposits? Or are we going to have to put up sort of scare screens every time they go from one asset class into the other, saying you're moving into an insured product, you're moving out of an insured product? So how do we kind of ensure that we can offer good customer journeys? So that's sort of, I suppose, a here and now concern. And then as a competition person, stepping back and looking at this and thinking about probably payments markets more broadly. Payments are always classic two-sided markets. And in two-sided markets, one side of the market has more elastic demand than the other. And the side of the market with the more inelastic demand is the one that generally ends up seeing the product as a must-take product, and they will pay whatever they have to pay to take that product. So if you look at card schemes today, Visa and MasterCard are must-take products for merchants. Card issuers get to choose between Visa and MasterCard, and Visa and MasterCard compete aggressively to win the business of the card issuers. But the merchants have no choice but to accept both. So you see merchants ending up paying probably above the odds commissions to Visa and MasterCard for card payments. If you look at digital wallets, the tables are turned on the banks, because actually Apple Pay is a must-take solution for any UK card issuer to take, and therefore we pay the price. Consumers use Apple Pay for free. So there's always one side of the market which is really paying out, and the other side of the market is getting it for free. So how is this going to play out in stablecoins. I think it's a bit early to say, but I certainly would say there are the same kind of scale benefits in stablecoins as there are in these other types of markets. So there are increasing returns to scale. It's perhaps not a surprise that we see two US dollar stablecoins really preeminent at the moment, because you do have those huge scale advantages. And then once you have the distribution, that gives you this enormous reach, and then you can go to the other side of the market who really wants access to that distribution and say, you need to pay us a very high commission. And I think we're going to see the same things play out, but whether we see that playing out from a perspective of the actual stablecoin issuers, or whether it's going to be the platforms that they operate on, it's still a bit early to say, but it's an area that I would hope competition regulators in the UK and around the world are alive to, because the thing with these two-sided markets is once they've tipped, it's really difficult to untip them. And so how do you try to avoid that tipping taking place? And I think really it's about interoperability. It's about maintaining kind of openness, having transparent pricing, non-discriminatory access, so you can't self-preference, you can't favour your affiliates. And if we build that in from the outset, which I think is what Sarah Breeden at the Bank of England has been talking about, you're going to reduce the likelihood that you get kind of extreme levels of market power that just generate economic inefficiency for everyone, ultimately for consumers and for everyone.
Can I
Yeah, of course.
pick up on
Of course.
one point that when you said before, and I completely agree with it, when you've got the difference between a deposit and a stable coin, and then potential warnings to customers, you're moving out of an insured asset into an uninsured asset, then I think you then got to look at the stablecoin issuer. And then this is sort of giving rise that if you've got an issuer that's regulated, say under the Genius Act or under other jurisdictions who are issuing regulations along the lines of the Genius Act, then you've got sort of mandated 10% cash, 90% short-term government.
Yeah.
So it's a lot more with attestation requirements, transparency requirements, then you've got more of that consumer confidence. Yes, it's not as insured,
but it's
a more confident asset.
It's by its nature a much safer asset to be holding, and I think that is a really interesting point. We're saying it's not you're not moving into an e-money provider, for example. It's a lot safer than that because of all the backing assets. Yeah. So I think that's going to be an interesting dynamic that we see play out as we do move into potentially customers going into their everyday banking app and wanting to do stuff with stablecoins. How's the PRA going to approach that?
But I think to that point, I think you're going to also, as you were saying, there are already two that are front runners. And when you're kind of first to market, one, you're constantly evolving and learning and adapting. And you're constantly renewing and refining your approach. And so they have an advantage. And there's also insurance value to being first. When you are well known and you are a household name, institutions and retail alike will probably lean more toward you. And I think that that's one of the things that when you talk to traditional finance, having 9 million different stablecoin issuers and you have to diligence each one, institutions would prefer just say we're going to take one or two because they can diligence those, they can ring fence them, they can have appropriate kind of risk management around those. And also the market, there's more transparency with regard to the assets. And so I think that, there's a lot of talk about all the different stablecoins that are likely to be issued, but ultimately they will be weeded out in the market, and there will likely be just a de minimis number of ones that are dominant.
Yeah, no, that's really great, and good to talk about that kind of perspective. Basically, how important thinking about these issues are when we think about just how to regulate from a financial stability perspective. Want to move on to cross-border, and I think maybe I'll start with Chris this time. It was something that we touched on at the start. This idea of decentralized finance, basically. First of all, Chris, do you think there's such a thing as DeFi, basically, from a regulatory perspective, or even in general? If we have to accept that there is a concept of DeFi that market participants believe in, what sort of challenges does that present?
An easy one.
Yeah.
So I personally think when a lot of people talk about DeFi, it's this concept of peer-to-peer trading, and therefore there's no central counterparty. And then I think people then often say, well, in that case, there's no one to regulate. It's just two people transacting. But I kind of see DeFi as really meaning, and I'm sure this isn't a word, but hopefully it will become one, disintermediated.
It's 100% agreed.
And so quite often, I mean, yes, there will be peer-to-peer transfers where you are just trading face-to-face, and that can happen now, although not as quickly. But I think that there will still be platforms that will facilitate the peer-to-peer trading. And if you're thinking about regulation, then that's who you regulate. And you regulate them either directly because they're in a jurisdiction that requires them to be regulated, and people are happy with the appropriate level of regulation, or I suppose indirectly because you're saying to people in your jurisdiction, if you're using that platform that's unregulated, I'm going to block you from using it.
Yeah, no, I think it's a really difficult one, actually.
So I think we will see over time the rise of different platforms, and at the moment I think a lot of them generally are regulated because they're in jurisdictions that won't regulate them, that don't want to regulate them. But I think and the market is definitely maturing, the institutions are looking at all this. I think there's a real desire to see those platforms regulated, and they'll either move, or the jurisdiction they're in will start regulating them, or new platforms will come up.
Right. Yeah. And I think people are worried about, when you think about disintermediation, it sounds great. The technology, that is truly achieving the full purpose of the technology, is that it truly allows disintermediation. However, with disintermediation comes risk. When you think about in the US system where DTC is the central clearing counterparty, they're the buyer to every seller of equity securities and the seller to every buyer. They remove risk from the system. You don't have counterparty risk because DTC assumes all of that risk. And so really, I think it's when people understand the infrastructure and why intermediation is there, then I think you can have a far more fulsome discussion about the promise of the technology. But I think oftentimes people are just so captivated by the technology, and they don't really take the time to understand the markets and the benefits that intermediaries oftentimes play with regard to risk management.
Just a short personal anecdote. So I played around with Bitcoin first around 10 years ago. And those were in the days where the exchanges, you couldn't necessarily trust them. So I had this thing called a Trezor, which was just a USB stick. Many people are probably familiar with it. And it was very exhilarating knowing that I had a bunch of Bitcoin on a Trezor stick. It was also absolutely terrible.
It's stressful, exactly.
Yeah.
You lose that.
It's gone. And you're just sticking in little codes into a screen to send this thing that's on your USB stick to somebody else's USB stick somewhere else in the world. It was very exciting, but very terrifying. And then once Coinbase came along and appeared to be, well regulated or reliable, I was very happy to put things on Coinbase instead. And I think that is a thing that it is, DeFi is probably where it starts, but just over time, we're just going to see more and more sort of control points that are regulated emerging. And I'm sure we'll still have DeFi in certain places. If you happen to live in Argentina, you're probably quite keen to keep it completely unregulated because you don't trust your local regulators, or you didn't. Whereas I think in more mature markets, I'm sure we're going to see 99% happening through kind of regulated control points.
And you're very happy to have your 12 words, basically, somewhere that will guarantee you. You could always recover it, even if you change your iPhone.
There's someone to sue.
Exactly. But no, absolutely. I think, I think regulators will always be skeptical of the idea that there's genuinely nobody to regulate somehow. And perhaps there's a risk that maybe if there's not a financial intermediary to regulate, you might actually start regulating the technology providers who have always been able to say, I wash my hands of this, I'm just a code writer. I think this is a really kind of interesting space. We've got a few minutes, actually, so maybe we might even be able to take some questions. But before we do that, I think we will kind of do some future, gazing, basically. So I'm going to ask everyone, each panelist, what is the single most important development that you think we will see in the next 5 years? So Simon.
Yeah, so I think I've got quite a few things I wrote down.
More than one is fine. It's okay. We've got time.
Yeah, well, I think stablecoins playing a leading role in agentic commerce, I think, could be quite an interesting one. So I've been doing a lot of work on AI, agentic commerce, agentic money management recently, and I think that certainly if you are somebody who works in stablecoin industry, you're going to be a strong advocate of stablecoins playing a role in agentic commerce because they have that. They are sort of machine-to-machine native. They have programmability. They're easily cross-border, and they can kind of slide in behind the existing merchant or customer interface. So you might think that you're paying with a card, but actually it's going on stablecoin rails in the background. So I think we could see that emerge over the next few years.
Yeah, no, I think that I personally am very excited about the idea of hello Ferdisha and stuff. Some little avatars in the world just do stuff on my behalf. I think that'd be exciting. Val, what are your predictions?
As a trading and markets lawyer, of course, I'm excited by watching the developments of the tokenization of the U.S. capital markets, just watching the speed at which DTC and its subsidiaries, NSEC and FIC, are moving toward the tokenization of all publicly traded securities, and they're working in hand with SIBO and NASDAQ and New York Stock Exchange. So I think seeing the realization of the tokenization of the capital markets will be really exciting, the 24/7 trading that it will allow, but also the fact that there are bound to be unintended consequences. And as a former regulator, I'm always interested to see what the response will be, because it's always more regulation.
And interesting that you're seeing that happening within 5 years. I think that is,
Oh, it's happening so quickly. Yeah. It's kind of mind-boggling.
Chris.
I think it's regulated stablecoins. I think the US have set the global bar, and with the Genius Act and with the associated regulations. And I mean, Guernsey is certainly very much, basically going to copy that. And I'm sure other jurisdictions are as well. And I think within hopefully within 12 months, we'll see a number of regulated stablecoin issuers. And I think they'll start to become the more dominant players. Unless unless Tether goes and gets regulation.
And maybe one thing I think we might not see, and this is very much a personal perspective, but I'm not sure we're going to see a GBP systemic.
Well, that was good. That was right. Okay.
To get to, we're going to get to a 40 billion issuance GBP stablecoin when, on the one hand, in retail markets you have tokenized deposits working their way through. And in wholesale markets, the Bank of England is very keen for settlement to be in central bank money. And they are perhaps working towards a wholesale CBDC. So that really sort of squeezes out, the use cases for a GBP stablecoin. I think the way I could see it potentially happening would be if a very large e-commerce retailer said, we're now going to accept stablecoin payments and we'll be offering a 5% discount to anybody who uses stablecoins. I think that's the only way I can see the sort of network effects gaining traction for GBP stablecoin. But the issue there is we do now have an alternative payment method to cards for e-commerce in the UK, which is account-to-account payments, which is also being sort of heavily promoted by HMT and by the FCA. So. Yeah, I think it's a slightly kind of tricky landscape if you're a GBP stablecoin issuer to think whether, do you want to be systemic in the first place?
Because we've got regulation for it, which is
do you really want to be, and if you, but can you be as well?
Do we think we'll see CBDCs? Maybe, Simon, you think there is a chance we might see a GBP one, a Bitcoin?
There's a possibility.
Are we still calling it that, Bitcoin?
Well, a wholesale one.
Right.
I don't think there'll be one at retail.
Right.
My
Right.
guess at this point in time. Yeah.
What about the dollars? Are we going to see a dollar CBDC?
The Fed has studied it at length and put it out for, I think in 2022 was the last time they put out a proposal for comment. Jerome Powell, the former chair of the Fed, made it clear he was completely disinterested. And then Kevin Warsh, the current chair of the Fed, also has a very similar kind of approach. I think that there's a belief that there's so much benefits to the current infrastructure in the U.S. when it comes to the dollar that there's concern about disrupting that. And so I think it's possible, but I don't think it's imminent.
Yeah. Probably have time for one question, maybe. If anybody has a burning question for any of our panelists. I see a hand. I think the mic is going to come to you.
I'm loud enough. I hope I'm loud enough, yeah. Now it is. Since it's more on stablecoins and crypto, right? So there is T+1 going around in US, etc., places with respect to settlement. What do you think about the relationship between, or how it could merge with stablecoins and the T+1? Maybe if you could share some insights, if I think it's related.
Anybody want to take that, Val, or anybody? The question is about the interaction between T+1 and stablecoins, basically.
But I think that's the promise of it, is that it will expedite transactions, and you won't have the lag time and the risk associated with the T+1 settlement. And so I think that's why so many people are interested, because of the cross-border implications and because of the reduced settlement time that's possible with tokenized, with stablecoins or other tokenized real-world assets.
Great. Thank you very much. And with that, I think I'm just left to thank the panel, actually, for a really interesting discussion. I mean, I learned, just taking furious notes as I went along, on a variety of topics in this related to regulation and the difficult questions that policymakers will continue to have to grapple with as we kind of go towards this future. So thank you very much. Thank you very much to the audience, especially for the question that we had at the end. And with that, thank you for having us.
Yeah, thank you.